Hello, I'm Nate Zeller, Chief Investment Strategist for Secure Retirement. Thanks for joining us today on, what is this, Monday, March 21st? I guess the first or technically second day of spring. Certainly feels like it out there a little bit. Today we're going to talk about the Federal Reserve and the action that they took last week, and as well as our outlook and how this might affect financial markets as well as inflation and all those hot topics on everyone's minds right now. So we'll go ahead and get into it. I think a lot of people are aware of what the Fed did, so I'm going to spend a little more time talking about really the implications of it. And I'm going to start out with a little lesson here. Hopefully, it doesn't bore some of you too much, but get a little info on the Federal Reserve and what it really is. Before we do that, though, we do have to give our disclaimers. These are opinions subject to change without notice. This is for general information only. Should not be is not meant as an offer to sell or buy any securities or investments. Today, since we're talking about the Fed and not necessarily the stock market in particular, I think that that's probably all right. We're not going to get into any sort of recommendations. All right. Well, let's start out, like I said, a little lesson here on the Federal Reserve and what it is. There's the Federal Reserve is the central banking system of the United States. It's comprised really of there's three major parts. There's a lot of overlap here, though. There's the Federal Reserve Board of Governors. And those are appointed by the President of the United States. They serve 14-year terms. They oversee everything that the Federal Reserve does. Underneath them, there are alongside, there's the 12 Federal Reserve banks. I'm going to skip ahead here, then we'll come back to this slide, that are all over the country. The 9th Federal Reserve or 9th District Federal Reserve is headquartered here in Minneapolis. There's also a branch out in Helena, Montana. So you can see within this Federal Reserve District, it encompasses Montana, both Dakotas, Minnesota, the northern part of Wisconsin, and the Upper Peninsula of Michigan. And each Federal Reserve District has its own president. Ours here in Minneapolis is Neil Kashkari. So then there's the Federal Open Market Committee here. That's the one when people talk about the Fed raising interest rates, that's who they're really referring to is the FOMC. And they're comprised of all 7 members of the Board of Governors, as well as 5 of the 12 Federal Reserve Bank presidents on a rotating basis. All 12 sit on the committee, but only 5 are allowed to vote at a time, in addition to the 7 boards of governors. This is on a rotating basis. The Federal Reserve Bank of New York president always votes, so it's really rotates. The other 4 votes rotate amongst the remaining 11 members. As far as what the Federal Reserve does, they conduct monetary policy. That's raising interest rates. That's primarily what we're going to talk about today. But the purpose of a central bank is to maintain stability of a financial system. The Fed also is responsible for supervising and regulating financial institutions. They provide services. So check clearing, for example, if you were to write a check on your bank, present it when you're buying something, then it goes through the system, and that's how it works its way through the Federal Reserve. They also promote consumer protection and community development. These Federal Reserve banks, the different districts, there's a lot of information and research that they do. There's some pretty interesting stuff if you go out and want to take a look. Another interesting fact is it's actually the Federal Reserve that issues our currency. A lot of people think it's the Department of Treasury, which it mentions right here. The Department of Treasury is responsible for minting and printing coins and bills, but it's the Federal Reserve that actually issues that. So as far as monetary policy of the Federal Reserve, there's 3 primary objectives: to maximize employment, stabilize prices. Those 2 are known as the dual mandate of the Fed. They're also tasked with moderating long-term interest rates, which really goes hand in hand with stabilizing prices. So when you look at it in the lens of this, it hopefully will help you understand what they're trying to accomplish when they do raise and lower interest rates and the different policies that they come out with. The tools that they have at their disposal is they have open market operations where they buy assets. This would be like buying bonds. We heard recently about their quantitative easing, where they were buying bonds and even some ETFs out in the open market. And what that does is it puts more money out there. We'll talk about money supply here in a second, but more money is available. It helps push economic growth. There's also something that we're going to hear more and more about in coming months, and that's quantitative tightening. That's where they sell assets. So right now, the Federal Reserve has a balance sheet of about $9 trillion. That's trillion with a T, so it's rather large. And what they want to do is get rid of that. They can wait for the bonds that they hold to mature and run off, or they can go out into the marketplace and sell them. And what that has the effect of doing is sucking money out of the economy, and hopefully in a way to reduce the money supply and reduce inflation. They also can alter interest rates, primarily the Fed funds rate, which is the overnight borrowing rate between banks. And so last week when they announced that they're raising interest rates by a quarter a point, that's exactly what they're doing. Again, talking about the money supply, why does the money supply matter? And to a simple person such as myself, it seems like there's an unlimited supply of money out there, but there really isn't. There's only a certain amount. So the more money that's out there, it's more money chasing the same number of goods, and that leads to inflation. Now, inflation isn't necessarily a bad thing. Some inflation is good. It's part of a healthy economy. It means the economy is growing. As things are growing, prices are increasing, as long as it's at a moderate pace. Now, if there's high inflation like we're seeing now, we're seeing inflation that's being reported in the high single digits. Some people might argue it's more in the mid-teens. That can be harmful to the economy. As a lot of us know, I mean, you have to spend your money on the essential items, food, shelter, clothing, and if those are costing more and your income isn't keeping pace, and then there's less money left over for discretionary spending on the things that you want to buy for fun. And so that's why inflation can hurt the economy and stymie economic growth. So the classic definition of inflation is too much money chasing too few goods. And then it's easy to use an example like apples. If there were, say, 5 apples available at a farmer stand at the side of the road, and there's 5 people there to buy apples, everybody would be able to buy an apple. Pretty simple. But now if there's 10 people there with more money, but only 5 apples available, the person running the stand's going to wise up and say, hey, I could charge more money for this because the supply is not meeting the demand. And it works the other way too. If you have too few buyers, then it can push prices lower. So there's some drivers of inflation, and we are going to get back to talking about the Fed here in a second. But just to help you understand kind of where we're at today with inflation, and I think when we boil this down, it'll make sense to most people. So we have something known as cost push inflation, and that occurs when there's a limited supply, and we've seen that through the pandemic. There's been some supply bottlenecks that have occurred. There's been increases in wages, for example. The raw materials just haven't been available, or the transportation, and so that's pushing costs up. The other part of it, like I mentioned, is raw materials. We're seeing a lot of that right now with what's going on in Ukraine, Eastern Europe, with energy prices, as well as a lot of the precious and industrial metals, as raw materials are pushing prices higher as well. So that's one driver of inflation. The other one is the demand. So what are people buying? And if you think back to the pandemic, everything was shut down. So people that wanted to spend their money were limited. Sure, you could still buy things on Amazon, but couldn't go to the stores. You couldn't maybe eat out or take a vacation. And what was also happening at the same time is the government was giving people stimulus money. So they had a lot more money that they weren't able to spend. And then when the pandemic started to wind down, it kind of busted the dam loose, and people were able to get out and spend that money. So there was more demand. And that was, I was going to say push prices higher, but they call it demand pull. So I guess it's pulling prices higher, but either way, it was leading to higher prices. So we saw it on both sides of the equation here, which is a bit of an anomaly and something we haven't seen in a number of decades. And again, the money supply, so this goes with the demand, is there's more money available out there. Household wealth, household savings in aggregate across the country happened to increase during the pandemic. So people had more money to spend on those discretionary items we're referring to a few minutes ago. So getting back here to why do interest rates really matter? I mean, what difference does it make if the Fed raises rates are not, and what it comes down to is borrowing costs. So think about this in your situation. If you're getting a mortgage or maybe buying a car, if you hear an interest rate of 1 or 2%, like we've seen the last 10 plus years, pretty low rates, you probably don't think much about it. But if interest rates move higher, 4, 5, 6%, you're probably going to have second thoughts and think it isn't worth it. And that's going to make those monthly payments that much more. And think about it even on a larger scale for corporations that maybe issue bonds or borrow money for growth, is they have to, figure what their growth prospects are, and does it make sense for them to borrow money, pay interest on it, and is that going to be enough, or are they going to grow enough to cover those costs? The other part of it is the present value of future earnings. This gets into the stock market a little bit more. So most stocks are valued based on their current earnings, but a lot of growth companies are, their stock prices are based upon what their outlook is, their future prospects for earnings. Then they're discounted back using the current interest rates. And if interest rates are low, that number can be pretty high, but as interest rates get higher, that number is pushed lower. It seems almost backwards. And so this is why we've seen a lot of the tech stocks not do so well here so far this year. Is there's fear of rising interest rates are going to make the present value of their future earnings even less. But primarily here, I'd focus mostly on the borrowing costs. So as interest rates go up, borrowing costs are higher, and that should reduce the amount of money, the money supply, like we're talking about. The demand would go down, and that in theory would keep inflation in check. So now that we've been through our little history lesson, we're going to talk about what they actually did at the FOMC meeting last week, which is a little pop quiz. It's Federal Open Market Committee, or the Fed, as most people refer to it. They did hike rates by 0.25%. They used to give a target as an actual percentage. Now they let it float a little bit. So the range prior to the interest rate hike was between 0 to 0.25%. Now it's 0.25 to 0.5%. So really still very low. Historically, this was the first interest rate increase since December of 2018. But it shows that they're going to move. And if you look back on this chart, going back to 2018, you can see how interest rates, historically speaking, the Fed, well, you go back to 2017 and they raised interest rates by 0.25 point, and then they waited for a while to see what happened, because interest rate hikes, they have an impact on the economy, but it's not instant. The most thinking is it takes about 6 months for it to work its way through. So the Fed's very deliberate in what they do, and they want to see what impact this might have and how it might affect the broader economy before doing more. And here you can see in 2018, they said, okay, things are still going all right. Maybe inflation's getting a little higher. Let's increase it a little bit more, so 0.25 point at a time. You can see when COVID hit that they dropped it very dramatically. Same thing happened back in 2008. They wanted to do all they could to help the economy, so they dropped interest rates to 0 nearly instantly, and that's when they started their quantitative easing and bond buying as well. There was some dissent with the Fed last week. One of their members, James Bullard, who's the president of the St. Louis Federal Reserve Bank, that district, had wanted to raise interest rates by 0.5 point. And he came out last Friday and said he thinks that the Fed ought to really speed up the interest rates hikes because they're really behind the curve. If we think about inflation right now, the CPI is being reported at, about 8%. And the federal funds rates at 0.25%, 0.25 to 0.5. I mean, they're really behind. So he's arguing for faster rate hikes. Another Fed president, Waller, came out talking to CNBC and pretty much said the same thing. And their belief is that he voted in favor of the 0.25 point, but he thinks that 0.5 point makes more sense. And so I think projections now, we'll talk about these projections a little bit more here in a second. Projections now are that the Fed's going to continue to raise rates at every meeting they have for the rest of the year. And they meet once every 6 weeks or so, give or take. So there's 6 meetings left in the year. And expectations now are they're going to continue to raise rates by 0.25 point at every meeting throughout the remainder of the year. But anyhow, these two gentlemen are arguing that they ought to probably do 0.5 point at 1 or 2 of these meetings, kind of to see what happens, because they are so far behind. that in order to control inflation, their piddly little quarter point isn't going to get the job done. To give you an idea of where we've been historically with the Fed funds rate, you can look back the late 70s, early 80s, period of stagflation, high inflation. And a lot of you probably remember back then the Fed funds rate was up in the high teens. So it's been very high historically. And I go back to right before we call it the Great Recession, the housing crisis in the late 2000s, the first decade of the 2000s, 21st century. And the Fed funds rate was at about 5%. And remember, now we're at a quarter to a half. So there's a long way it could possibly move. And the Federal Reserve, so I'd mentioned the CPI, the Consumer Price Index, a few minutes ago. And that's one measure of inflation. It's a basket of goods measured by the Bureau of Labor Statistics. There's also the Personal Consumption Expenditures Chain Price Index, and that's by the Bureau of Economic Analysis. It's just another measure of inflation, and this happens to be the Federal Reserve's preferred measure of inflation. This is what they watch, and you can see historically that the Fed funds rate, which is the red line here, has been much greater than the PCE number. And now we get down here to the end, we're really behind. The Fed likes to see this in the 2, maybe sometimes a 3% range. So we go back over the last decade, and Fed funds have been low. They've been below the PCE, but the Fed was okay with that because it was in the 2 or 3% range. And now the PCE is pushing 5. Well, it's about 6% now. And Fed funds is much lower, so it's come well beyond their range. So this is another indication that the Fed is behind the curve when it comes to raising rates and keeping inflation low. There's something known as the dot plot. So I was talking about the Board of Governors and the 12 Federal Reserve Bank district presidents. So what they do at a meeting, this is anonymous, is I think I'm getting some interference, sorry about that. So what they do at a meeting is they give their projections of where they think short-term interest rates are going to be at the end of this year, 2022, end of 2023, and end of 2024. And then they find an average. So you can see here that they're averaging out at about 1.9, which puts it in the range of 1.75 to 2% rate at the end of 2022, which is consistent with 6 more rate hikes this year of a quarter point. Then there's some outliers here that think we're going to see Fed funds greater than 3%. And there's somebody down here that doesn't think it's going to go up quite so much. And then in 2023, there's going to be more interest rate hikes, but you can see they're a little more clustered here, anywhere from they're right around the 2.5 to 2.75%. And then 2024 is at about the same place. So what it looks like is they expect a lot of interest rate hikes this year, a few more next year, but then really leveling off in 2024. And then longer term, they expect interest rates to move lower. So these are the Fed's estimates and their projections. What's interesting is this was the dot plot that was released at the meeting last week. Their dot plot released at the meeting in December was quite a bit lower. They averaged out at about 0.75, give or take. So they were looking for 3, maybe 4 interest rate hikes in 2022. So their expectations have come up quite a bit. And if we go back to September, they weren't expecting any interest rate hikes in 2022. So the point here is that we could see a lot more rate hikes coming than what's being projected now. And obviously it's very fluid given what's going on in the world, especially with the price of energy overseas, the situation in Ukraine. Really any commodities prices are going to most likely push inflation quite a bit higher over the next few months. So it remains to be seen if that's longer term or if that's kind of a short-lived issue that lasts a few months and then kind of goes away and we settle back down. So it'll be interesting to see what happens there. Something else I wanted to point out, and this is just some knowledge, is I oftentimes hear that, hey, the Fed's going to raise interest rates. I need to refinance my mortgage. They don't directly impact each other. When the Fed raises rates, it impacts short-term rates, and there is a relationship, but it's not a direct correlation between short-term rates and long-term rates. So on this graph here, the Fed funds rate is the blue line. The 1-year Treasury is the green line, so they do move in lockstep. That's short-term Treasury securities. Moves very closely with the Fed funds rate, anything short-term. But then the red line is the yield on the U.S. 10-year Treasury. And you can see that that stays quite a bit higher, which makes sense. You're borrowing money for a longer time period, so you expect to pay a little more interest. Or if you're buying treasuries, you're owning them for longer, so you expect to be compensated for a longer period of time. But you can see that they really don't move. The 10-year doesn't move in lockstep with 1 year of the Fed funds rate. It kind of does its own thing. It does tend to move up and down. We can see here lately it's really moved up quite a bit, which, looking at 10 years, that is also a reflection of inflation expectations over that period of time. But my guess is that the 10-year Treasury probably doesn't move up a whole lot more this year. We're at close to 2.25% right now. It might hit 2.5, 2.75, but we would expect the short-term rates to move up quite a bit more. And just because short-term rates move up more doesn't mean the longer-term rates are going to. And then, like I mentioned, the mortgage rates are based upon the U.S. 10-year Treasury yields, and that has an impact on housing and real estate as well. And we've really seen mortgage rates pop up quite a bit over the last few weeks, which makes sense looking at this chart and what 10-year Treasury yields have done. But I think at some point that's probably going to level off here, at least in the shorter near term. So I guess if I were to summarize this here is we expect more interest rate increases throughout the year. Current expectations are for 6 more quarter point raises. I would say if I was taking a bet on that I'd bet the over, that they might throw in a couple half points in there. Wouldn't be a surprise barring any major unforeseen event. I think that with inflation being as it is, it'll really drive more of these interest rate increases. Like I said, the CPI is being reported at, we'll call it 8%. The PCE, the other measure of inflation, is anywhere from 5.5 to 6. But Fed funds is quite a bit lower. So in order to have an impact, their Fed funds needs to come up, not necessarily all the way to that level of inflation, but to a point where it makes a difference, and that's probably at least at a 2.5% rate. The other thing I wanted to mention too is the Fed can't control all inflation, so they can control demand, which is the money supply. So as they raise interest rates, it reduces demand in the system. But we're talking about the cost push inflation that has to do with the supply chains and higher wages, for example. Then the higher cost of raw materials. The Fed doesn't have any control over that. So I think a lot of the inflation that's going on in the market right now is beyond the control of the Fed, but they're doing all they can and using the tools that they have available to control what they're able to. But I'm confident it will be enough. But hopefully, it could really get out of control. I don't see that happening, but we could see a period of something closer to stagflation that we saw in the late 70s and early 80s, which if interest rates go up quite a bit, it would hurt growth. Economic growth could slow down, and we'd see higher interest rates, which then in turn might also affect the employment situation. So, all right, I see a few questions here. Have any major banks raised their prime rate? Yes, they have. Generally, when the Fed raises their interest rates, the banks come out and raise their prime rate within the hour, within the same day, certainly. So all the banks have, and if any of you have loans based upon the prime rate, your interest rates probably have gone up. The amount of interest you're paying has gone up by 0.25% here in the last week. The SWIFT banking situation, the next question is, does the SWIFT banking situation have anything to do with interest rates? It does not. That's a way of how the payments work through the system. So the SWIFT system does not. It's the central banks that affect interest rates. The EU has a central bank, the European Central Bank. Bank of England is the UK's central bank, and that's going to affect interest rates more than the SWIFT system. They just facilitate payments really around the world. Are there any other questions here we can add to the chat? We'll give it another minute or two. I did want to talk about some of our upcoming events. Next Monday, a week from today, we have our Lunch and Learn. We'll have a outside guest, David Ness, who's a state and trust attorney. He's going to talk about change of residency. So a lot of people like to move to, I don't know, sunnier climates, which I kind of understand. So we see a lot of people move to Florida, maybe a few to Texas or Arizona. And David's going to talk about what it takes to change your residency, sometimes benefit from other tax laws, or well, different states generally have a little more favorable income tax situations than the state of Minnesota or Wisconsin for that matter. So that's what he's going to be talking about. And then on Thursday, April 28th, we will have David Walker give a special presentation. This is a live in-person presentation going to be held that Thursday out in Minnetonka. He will be here. I don't know if any of you know who David Walker is. He is the former Comptroller General of the United States. He was in charge of the GAO, the General Accounting Office. So he was America's bean counter, so to speak. He served under 3 presidents. Really a very, it's a great resume if you get a chance to go out and look him up. Some great credentials. So we're looking forward to having him here and hearing what he has to talk about. I've seen some other questions come in. Are ETFs good for inflation? It depends which one, because if you remember an ETF, it depends what it's the underlying. If they're buying tips, that would be a good inflation hedge. If they're buying stocks generally are a good inflation hedge. But if they're buying bonds, that would not work, because as interest rates move up, bond prices move lower. So that teeter-totter effect. So that's one thing about fixed income too, is interest rates are moving higher. Even the short duration interest rates are moving higher faster than the longer term in some cases. And so bond funds, mutual funds, bond ETFs are losing value right now. Will the fixed income investments start to increase percent? Yes, the fixed income investments probably will. That's the flip side, is we see yields go up, the percent that they're paying will also go up with that. So if you think about a mutual fund or an ETF, or we're going to ignore individual bonds for a second because those have a fixed rate and those don't change. But a bond ETF or a mutual fund, it pays based upon what their underlying bonds are paying in interest. And so what happens is that either they sell the old bonds that have a lower interest rate, or those bonds mature and they buy newer bonds. Then as they're buying these newer bonds, they're being issued at a higher interest rate. So the actual income being paid is increasing on fixed income investments, such, especially mutual funds and ETFs. But like I said before, sometimes the value is dropping. Let's see here. If the government encouraged increased oil production, would that also help bring down inflation? Yeah, I'm very biased on that topic. I used to work in the oil field. Apologies, I don't know if anybody else hears that in the background. There, finally quit. All right. So anyhow, yes, I think it's simple supply and demand in the oil field. Is right now we have a very limited supply of oil. Obviously, taking Russia offline more or less hurt too. We're importing oil from Russia. The Europeans certainly were too. So if there was increased production, it just makes sense that there'd be better supply, because our demand continues to increase. Our demand's pretty much the same, but it's increasing. We're using more oil, more energy, and so it's just that supply and demand equation there. So if the government did increase oil production, my opinion is, if they allowed pipelines, if they allowed drilling on federal lands, that they put a moratorium on, that it would certainly help out, because energy does play into really everything we do. If you think about the goods that you buy, they may be made with some sort of petroleum product. At a minimum, they're transported to where they got, thanks to petroleum in most cases. Even if it's an electric type vehicle, those have to get energy from somewhere, power plant. Next question, are I bonds a good inflation hedge? Yes, they are. There's some downsides to I bonds. You have to be careful with the way that you have to pay tax and the way that they adjust. So as long as you are aware of how they work, they are a good inflation hedge. They adjust their principal according to what inflation's doing. They reset on the CPI every 6 months. So that is a good inflation hedge. I bonds, though, you're limited. I never understood why the government does this, but you're limited to only buying $10,000 per person. at a time. So it makes it a little difficult, but that is a good way to hedge against inflation and probably makes more sense than buying a fixed rate bond. All right. Any other questions? Well, as always, we're here. If you have questions, give us a holler. Glad to chat with you about your portfolio, anything going on in the market. I'm wrapping up a white paper on inflation. We're getting it through compliance, so hopefully that's good to go here in the next few days. If you'd like to receive a copy of that, don't hesitate to let us know or give me a call, drop me an email. If there's anything else you want to talk about, market related, inflation related, don't hesitate to give us a call. We want to make sure that you're on track for your retirement and your plans in place and everything's running smoothly. So thank you all for joining. Appreciate you hopping on. Hope to see you again and enjoy the springtime weather. So take care. Thank you.